We shift our focus rather to the story now. South Africa's Tiger Brands reported a 4% increase in annual earnings, driven by price hikes to counteract rising input cost. However, sales volumes fell by 6% due to constrained consumer spending. Moreover, total revenue rose 1% to 37.7 billion rand, and the company declared a final dividend of 684 cents per share, a 1.9% increase from the previous year. Investment analyst Itembile Bupila offers her analysis on the company's performance.
Tiger Brands had a challenging year. Operationally, the environment has been tough across the consumer goods space. So revenue was only slightly ahead of last year. It was up 1% year on year, which did fall short of what the market was anticipating, but there was a notable improvement from the first half at least. So the group also pushed through price hikes to sort of offset the higher input costs, which also negatively impacted volumes and hence the revenue performance thus far. Headline earnings per share increased 4% year on year, but this again was all in line with management guidance, with improvement initiatives such as value engineering, logistics, and conversion cost savings driving the positive performance. They still paid a divvy. Granted, it was only 1.9% higher year on year, but it's still good testament to the group's overall operational and financial resilience. Cash generation was also quite healthy. They finished the year off on a net cash position compared to a net debt position last year. So evidently, management actions have started to somewhat pay off. A big risk factor for them, though, is still the listeriosis case, the class action that has been, brought against the group on behalf of the people who were impacted by the outbreak back in 2017. And so they still haven't determined what the liability in the case is going to be, but management did reiterate that its product liability insurance cover is appropriate for a group of its size.